Good morning. Thank you for inviting me. It's good to be with you in this virtual environment. My hope is to provide you with a sense of where the provincial economy is going, a little bit on where it's been, and just what this recovery process might look like. In order to do that, I've got to touch a little bit upon the global economic setting and a little bit upon Canada. But for the most part, I'm going to drill down into what's going on in BC, touch upon the labor market, and try and get a sense of just which industries have been hardest hit and what the next few years might look like as we claw our way out of a rather deep economic hole. So, just to start a little bit at the global level, the global picture, the COVID-19 pandemic has so far claimed more than 2.1 million fatalities, with more than 100 million infections worldwide. This, of course, not surprisingly, has resulted in the most severe contraction in GDP around the world in the post-war era. Interestingly, there is widespread variation of the impact across different countries, both in terms of containment as well as economic implications and negative economic impacts. This has implications for the global recovery, as we don't expect the recovery across countries to be even. Rather, it will be quite uneven in some instances. And we do expect the recovery to be quite choppy in the spring of this year. The first quarter in particular will be weak. BC is faring relatively well in terms of containing the virus, but other parts of the country are struggling and suffering. So we don't expect much in the first quarter, but as we move through the year, the economy will strengthen. And then the final point down there on the bottom, there is no doubt the COVID crisis has strengthened China's economic and geopolitical power. They've come through the virus quite well, and the economy there is set to grow very, very strongly relative to all other large countries or large economies around the world. So just quickly, the global economic outlook, a 3.5% contraction recorded in 2020, and we now expect a 5%, actually a 5.5% contraction in 2021. So the recovery growth, the rebound is actually larger than the downturn at the global level. This is not something you see in all jurisdictions. The U.S., you do see this. The U.S. economy, the economic impact, comparatively mild, particularly vis-a-vis Europe and Japan and even Canada. And then the recovery in the U.S. at 5.1% in 2021 is on the stronger end of the spectrum across the large countries as well. So that's good news for BC. The U.S., of course, our largest trading partner. About half of everything we ship goes south of the border. The euro area, obviously weak. That's a large contraction, 7.2%. And the recovery in 2021 doesn't even get them halfway back to all the output that they lost in 2020. At the bottom line there, China is interesting. Back in April and May of this year, most pundits and economists thought the Chinese economy would contract in 2020. Turns out that it actually expanded by 2.3%, and in 2021 will accelerate to a very, very robust 8.1% expansion. This too good news for British Columbia, as China is our second largest trading partner. Just a quick note on debt, just mostly out of interest. If we look at the debt load across advanced economies, we find that the amount of debt relative to gross domestic product, relative to the size of the economies, is right up at record levels, actually slightly higher than what it was in the wake of World War II. And similar story for emerging markets, their debt load relative to the size of the economy also up at record highs. So governments will be looking to bring the debt loads down. They'll be looking for tax revenue, additional tax revenue, and they'll be looking for additional growth to try and tame deficits and get debt loads under control. And just turning to the expected growth rate of Canada, the 5.5% contraction in 2020 to be followed by a 4% increase in gross domestic product in 2021. This is a forecast from the Bank of Canada, and they do foresee further strengthening in 2022, but the bank does go out of its way to note that the output gap in the Canadian economy will not be closed for some time, another year or two after that. So it will take a long time before before the economy is back to its full potential and there is any sort of inflationary pressures as a result of being up or in excess of full potential. So don't anticipate that anytime soon. Just a note on the deficit, wartime style deficits here in Canada. I would note the federal government has done almost all of the heavy lifting to try and fend off the downturn and provide fiscal support for businesses and families. It really has been the federal government that has done the lion's share of work. As a result, the federal deficit is going to be in excess of $380 billion in fiscal 2021, amounting to at least 17.5% of GDP. The deficit does disappear as some of these supports are wound down, or not disappear, but it does get smaller as these supports are wound down and the economy continues to grow. But over the projection shown here, we do see deficits right out to 2025, 2026. With respect to interest rates, I just put this up briefly to underscore the fact that interest rates have fallen in this downturn, and this has in turn provided stimulus, mostly it's most evident in the residential real estate space, home transactions, record number of home transactions in Canada. There's little doubt that buyers have responded to lower interest rates. It has improved affordability conditions, and this is particularly relevant and important in the lower mainland context where high housing costs are a concern and ongoing issue. Interest rates are expected to creep up gradually, but again, fourth quarter of 2021 only up to a percent at that point for the 10-year Canadian benchmark bond yield. So no quick move up in interest rates. And in fact, interest rates will be quite supportive right through 2021 and into 2022. The amount of stimulus the Canadian government has provided turns out to be high, and in fact higher than any other country around the globe if we compare ourselves to other G20 countries. Canada, when you include non-discretionary spending, which is automatic stabilizers such as employment insurance, we spent upwards of 20%, the equivalent of 20% of GDP. Great Britain, below 15%, closer to 14%, and even the US only spent 13%, only in quote marks, 13%, an amount equivalent to 3% of GDP, battling the downturn and providing supports for businesses and families. The triangles there are the growth rates in 2020, and it's interesting, there is very little correlation between the amount of stimulus provided and the growth that the country or the contraction that the country experienced at the same time. So one could suggest that Canada spent the most, but it did not pay off in terms of economic growth, at least relative to some other countries. I thought it might be worth just briefly noting how BC has done in terms of managing the virus and in terms of caseloads relative to other provinces. Here you can see British Columbia has about 12 or 13 cases, COVID cases, per 1,000 population at the end of January. If we turn to deaths, similar picture, well below the Canadian number. But we have in British Columbia around 0.2 deaths per 1,000 population. The hardest hit province, Quebec, in comparison, has over 1 death per 1,000 population as of the end of January due to COVID. The context for British Columbia heading into the virus, the COVID crisis in 2020 was actually quite good. And I think it's worth just taking a moment to reflect back on how BC did over the past 4 or 5 years, and the reality that if we look at average GDP growth between 2015 and 2019, BC was actually a leader. Just PEI had a stronger growth performance than British Columbia, but of course PEI is a very small province and not much contribution to the overall output of the national economy. So in many ways, one could argue that BC was perhaps the strongest, and certainly the strongest among the larger economies when we look at growth over the past 5 years. So this is good news. Now, where did this growth come from? This is another interesting thing to look at. What has driven growth over the past 5 years? You can see that average growth rate of 2.9% across all industries, but the leading industry or sector is construction. Construction always provides consistently, not every year, but over several years. When we look at construction and its contribution to the economy, it is always one of the top industries. It is a massive industry, and it led all other industries, at least at this level of detail, over the past 5-year period leading up to 2020. So good news for construction. It's interesting, food and accommodation was also a growth leader, as was transportation and warehousing. Of course, these are areas that were hard hit by the virus. So our growth leading industries, all comparatively hard hit by the virus, which is one of the reasons that the Canadian economy, or the BC economy, was a little bit weaker and contracted more so than the Canadian economy, just because our lead growth industries were hit head on by the virus. The next slide just digs into a little bit more detail, more refined industry level. I'm not going to run through them all, but I just thought it might be of interest to some people in the audience. Again, motion picture and video production was a huge growth industry. Between 2015 and 2019, the number of people working in that segment doubled. It was huge, but it too was shuttered for several months in the COVID crisis, which is unfortunate. That is another factor in BC being harder hit than the rest of Canada. Good news is film and television production has reopened, and it will continue to expand and help underpin growth in British Columbia. I won't go through, as I said, all the different industries, but I would make the point and note, if we look at the industries that show up on this list, they come from a whole bunch of different areas. You have resource sectors there, you have manufacturing, you have technology, and you have some consumer items and some transportation, gateway activity in there. So this speaks to the diversity of BC's export base and the resilient and diverse industry structure that BC does enjoy. Just going to turn to the overall growth profile before talking a little bit about the labor market impacts and the recovery process that we've seen here in British Columbia. But I put this up and show this just to highlight the fact that this 6% contraction is about 2.5 times larger than the downturn in 2009. So a much deeper recession. The countering that to some extent is that we do expect a 4.5% recovery in 2021. But again, this just does not get us back to our pre-recession level. That will take another year or so. And just a note on tourism, it's pretty well self-evident that the tourism industry has been hard hit. After all, international travel has essentially been shut down and shuttered. But when you see the picture and the numbers, the impact, it really is still quite striking. So this is the number of non-resident travelers coming into BC. So everyone coming into BC who's not a Canadian resident, from all modes of travel, flying in, driving in. And what it shows is that between April and October of 2019, we had 6.2 million people come into British Columbia, all of them spending money. Some are shorter visits, some are longer visits, some are business travel, but still 6.2 million coming into British Columbia, staying in hotels, spending money. Over the same period in 2020, we had 207,000. So that's a loss of 6 million. When we get the couple more months of data through November and December, I estimate that we will see a drop of 7,000 visitors into the province in 2020. So big hit, and this is where most of the pain resides and where the recovery is going to be slower. On the job market, BC, huge hit. Down 400,000 jobs, lost 400,000 jobs in 2 short months. But what has been surprising is the pace and speed of the employment recovery. Right now we are just down 33,000 jobs. That's only a 1.3% decline. I do put only in quotes because it's still a significant downturn, but not relative to where we saw or found ourselves back in April of this year. So somewhat surprised on the upside. It is understandable, and it does make sense though when one factors in the extraordinary amount of stimulus that government has delivered, and the fact that international trade has rebounded more strongly than many would have anticipated. If we look at the different age segments, however, the recovery, which is good news, is almost complete, or fully so, in the age category 25 to 54. So that core working age group has seen employment return to its pre-recession level. Where we still see job losses is in the younger people and the older cohort, but the younger people especially hard hit. Employment down more than 9% still from February. This is where you're going to see kind of a slow and very protracted recovery process. One of the reasons I say that is because in the 2009 recession, employment in this age group did not recover till about 2013. So it took 4 or 5 years. Similar process is likely to play out here. Older workers, not quite as hard hit. Employment only down 1.6% still. So it really is a story of younger people and to a lesser extent older people in terms of job losses. Now, it's also helpful to understand the variation across the different industries. This is a bit of a busy picture. I don't have time to dissect it too much, but essentially I've grouped together the harder hit sectors, the moderately impacted ones, public sector employment, and then industries that have grown and expanded almost right through the entire period that COVID has been spreading. So the harder hit industries, we did see employment recover, but as you can see here, it's leveled off, and this is why I think you're going to see slower growth and slower employment recovery processes going forward. That leveling off is going to continue, and it won't be till the sort of fourth quarter of this year where we see stronger growth in some of these areas, particularly the accommodation sector and the information and cultural and recreation industry, which captures large sporting events, music, concerts, theaters, and other things like that. So we'll need more widespread vaccination prior to employment recovering more fully in those areas. Retail spending, this is an area that again has also surprised on the upside. Consumer spending was flat for the better part of a couple years in British Columbia. Then the COVID crisis, of course, retail spending hard hit as non-essential retail outlets were closed. Then they were reopened, consumers returned, and partly because they had saved so much and partly because of the extraordinary level of transfers to households, people are out spending and spending significantly, and there may even be some pent-up demand. And if we look at the different categories of spending, perhaps indeed some pent-up demand is part of the story. You can see motor vehicle spending weak, falling by 30-40% year over year in May, then recovering, and in more recent months motor vehicle and part sales actually higher than they were year ago levels as we move through October and November. And gasoline stations hard hit as travel and commuting reduced. Gasoline sales still down from the previous year. Clothing stores very, very hard hit, and sales still down on a year-over-year basis in November. A little bit of mixed performance for furniture and home furnishings. On the other side, this is where it's interesting because not all of retail was hard hit or hurt by the closures. Sectors and segments that remained open, such as food and beverage stores, have enjoyed strong growth in sales activity, still 10% on a year-over-year basis. Building material and garden equipment supply stores, also very strong year-over-year growth. So a mixed picture across the retail segment, but the key message is that consumers are out spending and spending quite robustly. So this is going to help underpin and contribute to BC's recovery in 2021. As is the construction sector. Non-residential building permits, Yes, they trended down in 2019, but this is because of the LNG, the building permits related to LNG construction and some of the facilities and structures necessary to complete that project, as well as several large office towers that got underway perhaps early in 2019 or later in 2019. As we move into 2020, yes, permits are down from 2019, but I would make the point that they're still running at a fairly elevated level when we compare ourselves where we were at, say, in 2015 or 2016. So promising news on the construction front when we look at non-residential building permits. And if we look at them between metro and non-metro areas, it's interesting that in the non-metro areas, building non-residential permits have held up somewhat better than they have in the in the metro areas. The reason for this, again, is large projects, LNG Canada, some other structures and facilities, and it's consistent with what we see: stronger employment recovery outside of the metro areas, movement, population growth, we'll touch upon in a moment, picking up in the non-metro areas. So there does appear to be a bit of a rotation towards some of the smaller communities around BC, and less activity in Metro Vancouver for the time being anyway. Interestingly, just looking back on what has driven growth, I thought this was relevant and interesting to the audience just because it underscores and highlights just how important the large LNG projects, related construction activity, related pipeline activity, the building of large towers and several large towers in Vancouver were to BC's economy in 2019. If we decompose the different contributions to growth by spending across different segments, you can see what I've done here is I've essentially delineated non-residential structures on their own, their contribution to growth, how much spending occurred and how much that provided or lifted economic growth, and then the other segments: consumption, residential investment, investment in machinery, equipment. They also contribute to growth. Those 4 or 5 different segments have been lumped together and are shown collectively in the blue bars just to highlight and underscore and show the non-residential sector. Jumping to 2019, you can see there, out of the 2.7% growth that BC enjoyed in 2019, non-residential construction investment accounted for fully 2 percentage points of that 2.7%. So it's fair to say, if we didn't have LNG investment and a few of the large towers in Vancouver and a couple of other large projects, the provincial economy would have been close to stalling in 2019. So good news and a good, helpful, useful lift provided by massive levels of capital investment here in British Columbia in 2019 and continuing today. Growth in BC, minus 6% expected in 2020, a little bit deeper, a little bit worse than the Canadian number because of some of the factors I've already identified. 2021, however, we do expect BC to actually slightly outpace the Canadian growth rate. Part of that is the recovery in film and television. Part of that is ramping up construction activity fully rather than on a scaled back basis due to COVID at the large construction sites, including Site C and LNG Canada. Part of it is also the fact that when airlines are flying again and people are traveling again, perhaps towards the end of the year, BC will get a lift, an oversized lift from that as well. The job numbers, employment, labor force figures are in for the entire year. It fell by 6%. We do expect almost a full recovery in 2021 with a 5.5% expansion. Unemployment rate now down below 10%. That's good news. It will continue to trend lower. And with the robust amount of housing activity, strong sales, we do expect home building to pick up in 2021 as well. And as I mentioned, because the federal government has done most of the heavy lifting, sure, BC's deficit is going to be large, lost a bunch of tax revenue with the downturn in the economy, and also spent additional money, but not nearly as much as the federal government. So BC facing a deficit of around $13 billion this fiscal year. And just a couple quick slides on migration, and then I will wrap it up and turn it over to questions. But I thought people might be interested in just understanding first the reality that population growth really does help underpin economic growth in BC. We see steady inflow of people into the province, and most of BC's population growth does come from migration into the province. And here I show migration from all sources, international migration, as well as interprovincial, over the first 3 quarters of each year, and you can see steady growth. If we look at the different segments of immigration and migration, the blue bar there shows net immigration, fairly steady in BC over the years. It does cycle to some degree, but we consistently get at least 6,000 or 7,000 or 8,000 people each quarter from international sources into British Columbia. Interprovincial migration, sometimes we get outflows, but most normally over the past 2 decades it has been a net inflow of people from other provinces. But where we're really seeing the shift in recent years is in non-permanent residents, and these are students coming to study in the province, as well as temporary foreign workers. We've seen a big increase in the numbers there. COVID derailed that and shut that flow off for a while, so we actually saw a tiny net outflow. But I expect when people are traveling again, that these temporary foreign worker these temporary net non-permanent resident numbers will rise and provide additional lift to population in British Columbia. Just a couple notes on population flows within BC. Everybody knows that housing prices are high and the cost of living is very high, and I think this is showing up in the reality that people are choosing to move out of the Lower Mainland to other lower housing cost jurisdictions in British Columbia. And you can see here the net intra-provincial flows. In the Lower Mainland, we used to get maybe 2,500, 3,000 people moving to other jurisdictions in BC, but in the past several years, that number has risen to nearly 12,000. So almost a quadrupling of the net outflow of people out of the Lower Mainland to other regions. Where are they going? They're going to Vancouver Island. They're going to the Thompson Okanagan. This is resulting in a fair amount of pressure in some cities, particularly in the interior as well as on the island, in that population growth is happening very rapidly, and some of these cities are smaller, so it's more difficult to absorb big numbers of people coming in a short period of time. Also note, although it's harder to see, the Kootenay and Caribou also both receiving a net inflow of people from likely the Lower Mainland mostly, and this wasn't the case several years back. And even the jurisdictions or regions that have small net outflows have seen that net outflow diminish, again likely because more people moving up to those areas and perhaps fewer people moving out. Quick recap, and then we will hopefully have some time for questions. No doubt Canada and BC experienced the steepest economic decline on record, and the recovery process is going to be somewhat bumpy and uneven as we move through 2021 and 22, but I am optimistic BC is fairly well positioned to grow, and for that growth to be sustainable over the next several years. There is definitely a chance in the post-pandemic era there will be some lasting changes in consumer business behavior. The most obvious is remote work, what we are doing right now, meeting virtually rather than in person. Some of this remote work I do expect will stick. There's economists and HR people working furiously trying to get a sense of exactly what how much will stick. I've seen estimates of 20 to 30% of the remote work and hours worked remotely will continue to be done so on a remote basis. Industrial structures are changing, consumer behavior, of course, shifting to online purchases. And the like. It will be very interesting to watch just how the return to more normal conditions unfolds over the next several years. In BC, export, capital investment, large projects, LNG, and other construction and consumer spending are all contributing to growth. So what I see is actually a very balanced recovery and durable recovery process over the next several years. The fiscal position of government, of course, tough, particularly at the national level. Debt to GDP ratios could reach 60%, as noted there. But I would just make a couple comments in that regard. Back in the late mid 1990s, Canada's debt to GDP ratio did reach 70%, so we're not in record territory yet. And I would also note that the interest rate environment was very different back in the 1990s. Much higher interest rates made carrying costs of debt much higher. Today we have low borrowing costs, so the ability and capacity for governments to borrow in a low borrowing cost environment is much greater. And then finally, I continue to believe the medium-term outlook for BC is generally positive. We have a very diverse industrial base. We're well positioned vis-a-vis Asia, the Asia Pacific, and it's always good to keep in mind that the Asia Pacific is on track to account for 50% of all global economic activity before 2050. So BC wants to be aligned with that. We want to continue to trade with China and other Asian countries and take advantage of that as we try and secure a more prosperous and strong growth future. Thank you for that, and happy to take questions anytime.